Hello, and thank you for joining us today for our webinar, Solving for Liquidity with the Reverse Mortgage. I'm Jenny Werwa, the Director of Public Relations for the National Reverse Mortgage Lenders Association. This webinar is one in a series for our third annual Reverse Mortgage Education Week. So far this week, we've talked to consumers very generally about using home equity to supplement their retirement savings and support aging in place. Experts have also joined us to talk to audiences about different ways to pay for long-term care, from Medicare, Medicaid waivers to veterans benefits, and also about converting housing wealth into a liquid asset that can be used to pay for either a professional home care provider or to support a family caregiver. The key term there is liquid asset. There are financial products available to help a homeowner turn their home equity into cash, but only one is specifically designed for people who are 62 or older, so retired or nearly retired, and that's a reverse mortgage. In a moment, I'll be introducing three experts who will talk about why it's important to consider whether your clients could benefit from incorporating housing wealth into their retirement financial plan. They will also present specific examples of how a reverse mortgage can help to meet your client's goals. So please pose your questions in the chat bar in the GoToWebinar toolbox, and we'll get to as many of those questions as possible at the end of the presentations. And as a reminder, webinar participants seeking recertification through the American College may claim 1 hour of CE credit towards the CLU, CHFC, or RICP designations. And now I'd like to offer some bios on our three experts. So next slide, please, Daryl. Jamie Hopkins is an associate professor of taxation at the American College of Financial Services in the Retirement Income Program and is co-director of the New York Life Center for Retirement Income. He also holds the Larry R. Pike Chair in Insurance and Investments at the college. Teaching courses in retirement, estate planning, and life insurance, he has educated thousands of financial services professionals and continues to move the needle for retirement income planning. Professor Hopkins is recognized as one of the leading retirement planning experts in the U.S., and in 2015, he was selected by Investment News for its list of the top 40 financial services professionals under the age of 40. Professor Hopkins has also contributed numerous articles for periodicals including the Villanova Law Review, the Nebraska Law Review, and Hastings Science and Technology Law Journal. And he's authored articles published by the American Bar Association and the Pennsylvania Bar Association. He's also the author of the new book, Rewirement. Jud Lyman is a training manager at Liberty Home Equity Solutions, where he focuses on sales coaching, product training, and helping financial advisors understand how their clients can benefit from a reverse mortgage. Prior to taking on the role of training manager, Jud began his journey with Liberty in 2010 as the wholesale marketing manager, where his main focus was helping Liberty's approved partners grow their business. After earning his bachelor's in journalism from CSU Sacramento, he spent nearly 15 years as a marketing professional at financial organizations such as E-Trade and the Dentist Insurance Company, and we're very proud to have Jud as a member of the NRMLA Education Committee. And Becky Bell, a certified financial planner. Becky brings a unique perspective to the home equity conversation. She's been a CFP for over 20 years. After beginning her career in financial planning, pivoting to insurance products, and later focusing on senior products such as long-term care insurance, she began working in the reverse mortgage industry in 2006. She spent the next 11 years leading sales teams focused on educating financial advisors about how and when to consider home equity strategies in a broader financial planning conversation. She recently returned to financial planning and is currently the president of Carter Financial Management. So thank you very much to our speakers. Thank you to all of our attendees. And now I'd like to hand the presentation over to Jamie.
Thank you, Jenny, for the great introductions and lead-in for everyone. And, thank you, everyone, for taking time out of your day to join us. So I'm going to kind of frame some of the conversation. And, I know a lot of the people that are watching today, we're going to be kind of preaching to the choir in some of these areas when we're talking about home equity and why it's so important. But I do think the framing of this in the conversation of liquidity and solving for that issue is really important. And kind of why do we need to consider it? Why, is it so important when we're talking about retirement planning and retirement income planning? And then from the financial advisor's perspective, that kind of looking at this as a different way and not just looking at it as a product or solution with a reverse mortgage, but actually looking at the home itself and, where does kind of prudent advice fall around using the home equity. So this is a slide I've been using for a number of years, and this comes from the last U.S. Census Bureau data, which is looking at the median, so really kind of the average, in a sense, American couple at age 65, looking at their non-equity investable assets compared to their equity in their home. Now, both of these numbers you would assume have changed a little bit since 2011 as the market's gone up, housing prices have gone up, but you could essentially inflate them from there if you wanted. But this just shows a very important picture. And what the picture really tells you is that the home is a huge part of the average retiring couple's assets when they get to retirement. It's really still America's largest single asset. So, this is just important, right? You have to think about it that we can't ignore that, right? If you went to court one day and said, hey, I'm dealing with my client, I'm going to ignore that 68% over there that's the green part and just deal with this other part over here in the blue, that really doesn't feel like a prudent thing you'd want to tell a courtroom, a judge, or really even your client, that you're going to ignore that much of their home equity. So I always just like to start with that. It's a good visual representation of why this kind of conversation is so important. Then the next part here is really what I mostly do in kind of my work and then at the American College is, talk about retirement income planning, right? That distribution time frame when we kind of move from accumulation to spending down assets or at least turning assets into a consistent and sustainable income source throughout retirement. And what we'll see here is I usually start off this with kind of a process, and I'll show you about another slide, kind of the process that I have used or a modification of it. But it starts with this first part of client goals. Really, retirement income planning is goal-based planning. It's not about just accumulating as much wealth as possible. It's not even just about accumulating as much income as possible. Those for some people might be important, but in most situations, really the finances here, our financial decisions are really just a means to the end. They're a means to achieve the lifestyle goals that somebody wants, both in retirement and, if they're continuing to work throughout their life. It's about achieving, financial security, being able to take care of yourself. And that's really why the financial planning process is there. It's about you and your goals, not just about the dollars. Now, when we're trying to meet the goals, right, once we develop them, then we can start figuring out, where do you put more value on, right? Are you more concerned about sustainable, guaranteed income? Are you looking at making, large contributions to charities? Are you concerned about your legacy to your heirs? And then what risks are you concerned about? Are you concerned about longevity? Do you have that in your family? One of my coworkers at the American College, his dad lived, David Littell's dad lived to, I think, 103. David was an Olympic fencer. And so when I look at David, I always say, we basically have to pick 100 or more for a reasonable life expectancy, probably 105 when you're looking at him. And you're saying, okay, that's really hard. Like that's some true longevity risk associated with you. So you need to build a plan kind of around that to meet those goals. And, as Jenny actually mentioned before, long-term care, medical risks in retirement, and that's a big concern for many individuals out there because there is a lot of unknown around there. And especially when you look at kind of long-term care, how do we fund this when we need care? We can't go back to work to fund it. That's kind of the essence of needing long-term care. So we can't take care of that situation for ourselves once we need the care. It's very different than almost all the other risks that we face in our life because it is something where now we have to have the funding in place and we have to allow somebody else to take care of us. So again, driving liquidity for a lot of these issues because you're going to need to make payouts at different times is very important. I'm not going to spend much time on public policy risks today, even though typically what I relate that to is just having flexibility in a plan that, when we're thinking about public policy risk, it's the risk that tax laws change, that Medicare changes, Social Security changes, and that does require us to be at least somewhat flexible with our plan. Now, the next part here is just what I use as the kind of our 10-step retirement income planning process. We don't really need to read through all 10 of these right now and go over them, but I pull out number 4. And number 4 essentially says, one of the things we need to do, right, we start with the goals, we see if there's shortfalls, et cetera. Then we need to identify sources of income and assets available to generate retirement income. And so where does this come from? Well, we do need to take a holistic approach. We can't ignore human capital, right? The house, social capital, all of those things need to be considered to generate the income that we need in retirement to actually, right, meet our goals. So the house is a part of that conversation. Now, the next piece here is a fun one that never seemed, that actually has probably been going on in my mind for a greater part of 90 years now and is nowhere near being settled. But it's the idea of, in the financial planning community, you know, what is the role of kind of fiduciary advice or acting in the best interest of the clients? Now, there's not necessarily one definition of that. We've kind of heard, you know, the Department of Labor stuff back and forth, AARP, and a couple other states have now pushing the Fifth Circuit to kind of move forward and review the rule again, because the Department of Labor won't. But that's kind of a specific fiduciary rule, and you can hold yourself out as a fiduciary, CFPs, which I know we have at least 2 of them on this leading this call. So there's a lot kind of wrapped up in there. But really kind of the core of this is just, you know, are you providing prudent advice to your client, acting in their best interest? And that doesn't mean you need to be an ERISA fiduciary to do that. And so I usually go through this list and say, you know, when you're providing advice, you know, what are some of the things you could ignore and say that you're still providing prudent advice, right? Would it be prudent to say I'm a financial advisor and I ignore all of my clients' stocks, that I don't include them in any of the planning? And the answer is obviously no, right? And we know that one. And then they say the next one, can we ignore their bonds and say we're providing prudent advice? Again, no. Can we ignore their tax rates? No, even though, right, financial advisors clearly list on almost every document, every email that they don't provide tax advice, but do they need to consider the tax impact of their advice? And 100%, again, the answer is yes. And that actually is if you're a fiduciary or not. We've seen many agents also get in trouble for ignoring tax information too. Their risk tolerance, again, another one that's clearly yes. The kind of driver of this conversation here today, liquidity needs, right? Can we ignore liquidity needs of a client? And again, that answer is clearly no, even if you're an insurance annuity agent, right? We've seen a number of cases there where ignoring liquidity needs of a client, that's actually squarely in the suitability. So then we get to the last one, right? And this one is an area that advisors have ignored, home equity. But if you think back to that first slide, does it make any sense that we should be ignoring that one while we have to pay attention to all these other ones, which are actually tend to be, all in all, smaller assets, smaller impact on the client? And that's a little bit, you know, it's a little hard to rationalize that together. It really doesn't work. So now I do kind of bring out 2 of the big other kind of elephants in the room about this. Is one, you know, there's really not a whole lot from FINRA about not recommending things. I'll mention a couple things. There is no case proceeding, hearing that I've been able to find that says, you know, somebody can get in trouble for not recommending a reverse mortgage. However, there are cases, hearings, procedures that say you should have recommended refinancing and not considering liquidity or debt management when putting a plan or making recommendations to somebody has been deemed kind of a breach of duty. So that while the kind of using a single product, no, but liquidity, debt management, refinancing, those have come up. And so, you know, kind of in that discussion, should you be bringing up, you know, the full range of solutions? And I think the answer there, again, is going to be yes. Now, some interesting developments in the last couple of years. We have now seen a lawsuit against a large financial institution. It looks like it might have been settled or wrapped up at this point, and not 100% clear on what happened to the case. But what did happen here is essentially someone sued life insurance agents saying that I was not informed that I could do a life settlement secondary market sale of my product. And actually, that was their argument, that I wasn't informed that there was an outside option here. And the court essentially said that this is at least enough to move forward with a case, and that the continuing premium payments that you had to make on your existing policy were enough to show at least kind of the face of damages. Now, that doesn't mean the case would have been a winner, but it does have some validity just in the sense that ongoing payments for something could be enough to show damages. And I think, again, because that goes back to liquidity. I'm going to kind of skip this one right now because I do want to make sure we can get over to the other people here. So the next piece here is just advice. And I think when we're providing advice, one of the things is we need to be very careful with what we're saying. We can explain things like what a reverse mortgage is, how it impacts liquidity without providing advice. Advice is you should do something, this is why you should do something, as opposed to this is what would happen if you did X, Y, or Z. Those are actually two different things, and it seems very similar, but they are treated differently, and attorneys, professionals have to be careful with their wording, careful with documentation. And then I also say careful with holding yourself out as comprehensive in any manner. If you're excluding a third or two-thirds of your client's assets from your planning and you're not including all the products and solutions available, it's a little bit misleading to call yourself doing comprehensive planning. Then the last piece here is just, kind of getting back to what I brought up before, right? What is kind of prudent advice for a client when you're talking about income planning, solving for liquidity, right? You couldn't ignore Social Security, a pension, annuity, their tax rates, marital status, debt obligations. So you really shouldn't ignore other products that can help with liquidity and these solutions. So then last piece from mine, that's actually, I guess, thanks for putting that in. It's a shot of my book cover, which came out a couple of weeks ago, Rewirement, Rewiring the Way You Think About Retirement. And yeah, you can check that out on Amazon if you want. And I will skip through that part over to Jud. And Jud, if you want to take it away now, be happy to let you get going.
Excellent. Thank you very much, Jamie. So what I want to talk about now, where we want to move the conversation is to kind of the reverse mortgage product in general. And I don't expect anyone or even want anyone to try to become an expert with what we're going to go over today. I just want the first part of my session is just going to be to give you some basic information about the product, and we're going to want to spend the most of the time here in my last two bullets, the retirement strategies and right sizing the home. So I've got 4 specific strategies that we've come up with that can help, where you can implement the reverse mortgage product into an existing plan that you already have, and try to show the impact that it may have on the borrower's investment account with you. So let's go ahead and jump into the basics. So typical retirement planning, as I've talked to financial planners over the last several years, we most of them talk about the 3 main tenets of their retirement plan that they work on with their clients. They've got their savings, retirement savings account, Social Security, maybe a pension. And I'm suggesting, as Jamie just talked about when he showed his numbers for non-equity assets and equity assets, right, that we add a 4th component to that, and that's the home equity of the borrower. And this is where the reverse mortgage comes in, right? So using home equity to supplement retirement income can provide tax-free cash to the borrower, requires no monthly mortgage payments, right? So it's not increasing their monthly expenses, right? They don't have to make those payments, right? And then the homeowners do stay in their home and retain title. One of the main purposes behind the HECM program is to allow borrowers to age in place, to stay in their home, which is where they want to be, and this product helps facilitate that. So as we look at some of the basics of the program, right, we talk about, I've already mentioned the HECM, the home equity conversion mortgage. That is the FHA insured version of a reverse mortgage. I will probably use both HECM and reverse mortgages interchangeably in this presentation. Hopefully that doesn't confuse anyone. What we're talking about there are the same thing. Some of the program features, again, like I mentioned, it does improve monthly cash flow. There are no monthly mortgage payments due. That's the principal and interest payment. They are responsible for maintaining and staying up to date on their taxes and insurance, right? Loan proceeds are tax-free, right? This is, you're borrowing money. This isn't income. Even when you set the program up to have monthly deposits into a bank account, right, it may look like income, but it's not. It is simply equity that you're borrowing against. right? Heirs inherit any remaining equity. That's one of the biggest concerns that I get when I talk to borrowers about the program. They want to make sure they have something to leave their kids. This program doesn't take that away, right? We're not buying their house. The lender's not buying their house. FHA is not buying their house. We're simply lending them money. It's a mortgage. It's a loan against the property. Any value of the property over and above what is loaned is going to stay their heir. It's going to stay for their heirs. Right, and there are multiple ways that we can access the excess equity that's available for the borrower. And then last but not least, interest may be tax deductible when the HECM is repaid. Now this is something I kind of tap dance around lightly, given that I'm not a tax professional, but there are certain ways when you make a payment into your HECM, there are certain processes that it goes through where it pays off certain portions of it first, and those could potentially be tax deductible in the year that they were paid. So if you don't make any payments, the year the loan becomes due and payable, all of that would be done. But if you make partial payments along the way, you might still get a similar benefit as far as interest deductions and things like that as you would with a typical mortgage. So when we look at eligibility, the youngest borrower has got to be at least 62. However, if you have a spousal situation where, let's say he's 64 and she's 58, that's fine. We can still do that loan. It's just the 64-year-old would be the borrower on the loan. The spouse, though, does have protections in the program. The homeowner's got to live in their home as their primary residence for at least 6 months and a day. You can only have one HECM at a time, and you can only spend 6 months and a day per year in a home at a time. So it was HUD did kind of wrap that up in a nice little tidy little bow for us, right? They've got to be able to pay off their existing mortgage using the HECM loan proceeds. So at the end of the day, when the HECM loan is closed, it's got to be in first lien position. There can't be any other liens against the property, and then the property must be an eligible property type. Some additional conditions that go along with the loan: borrowers are required to complete third-party counseling. The property must be maintained to FHA requirements. Not a huge deal. It has to meet those requirements before the loan can be closed anyways. They just have to meet them going forward. Again, they've got to continue to pay their property taxes and homeowners insurance. There is a lending limit, the FHA national lending limit of $679,650. That's kind of our starting point for reverse mortgages. And as I already mentioned, the loan's got to be in first lien position. Now, because of the way the loan is structured and our specific audience, right, individuals 62 or older, there are specific protections that have been put in place for the reverse mortgage. The first is this is a non-recourse loan. So the parameters set around the loan the day the loan closes are basically set in stone until one of the three maturity events happens. Nothing's going to change that. Right? It's also what allows the borrower to not ever have to pay back more than what their home is worth. Right, we talked about the third-party counseling. HUD wants to make sure that someone outside of the sales process is talking to these individuals and making sure that they understand what it is that they're signing up for. So that's an additional layer of protection for the borrower. The lender, FHA, we're not added to the title. We're not buying their home. It's still the borrower's home. Right? It's still your client's home. Nothing's going to change that. Right? The property always satisfies the lien. So I'll have a slide in a little bit that might show this, but even if you get into a situation where you owe $150,000 in your reverse mortgage and now because of a market condition, the home's only worth $100,000, neither your client nor their heirs are going to be responsible for that additional $50,000. Right? That's where the FHA insurance kicks in and covers that for the borrower. There's anti-steering regulations to help make sure that the lender and the originator is putting the borrower in the best product for them. Right? It's not a matter of what's best for the lender. It's always a matter of what's best for your client. Right? And then at the end of the day, there's always the right of rescission. With a typical refinance, it's 3 days from the day the loan closes. Borrower has a chance to change their mind. So anytime from the time they sign their application up until the day before the loan funds, which is 3 days, again, 3 days after the loan closes, they can change their mind at any time, right? And no harm, no foul. Right? Now, I mentioned this already, but I want to go over specifically. There's only 3 times that the loan will become due and payable. That is one of the protections. Right? It has nothing to do with the value of the home. The value of the home is basically irrelevant during the time that the loan is in place. The 3 times that the loan will become due and payable is if they fail to stay current on their property taxes and homeowners insurance. Right? And that one's a pretty easy one to understand. Right? If you fall behind in your taxes, then potentially you're going to have the taxing authority, like the county, put additional lien on the property, or potentially even foreclose if things get bad enough. So, as a protection for the lender and for FHA, the home is the asset, so we do have to require that they stay current on their taxes and insurance. Right? If they no longer live in the property, right? If they move, that makes sense. It's no longer their primary residence, so now they have to. Now the loan becomes due and payable because that is a requirement. And last but not least is if they fail to keep their home up to FHA standards. I use this picture more for shock value than anything, but basically these are things. This would be a reason why the home wouldn't necessarily meet FHA standards. Right? It's not a high bar to cross, but if the home becomes basically unlivable, dangerous for someone to live in, someone's going to have to. That loan would become due and payable. But to be perfectly honest with you, from my experience here at Liberty, I could probably count on one hand the number of times a loan has become due and payable because of this. Next up are the loan fees, right? It's a loan, right? It's a financial product. There are going to be fees to get involved. The fees for the reverse mortgage are very, very similar to a traditional mortgage. You're going to have a loan origination fee. HUD does have a specific calculation to determine how much that would be, and it caps out at $6,000. There are third-party closing costs, appraisal, flood certification, title insurance, all those types of things. Those are all part of this program as well. Then at the bottom, I've got the closing costs. Because this is a national audience, the range is really too wide for me to put in anything that would mean anything to the audience. So I would say that they are very typical to what happens in what I call a traditional mortgage. So if you know the fees that are associated for your area, it's going to be very, very similar to for a reverse mortgage. Now when we get to the reverse mortgage specific fees, there are a few things that are unique, at least when compared to conventional mortgages. I mentioned the counseling. The HUD counseling does cost generally between $75 and $125. Usually it's pretty close to $125. This is something that the borrower is responsible for. There are certain counseling agencies that will allow the borrower to roll the fee up into the loan and be paid out at closing, but that is completely up to the counseling agency to do that. Then you have the ongoing mortgage insurance premium. So this is that protection that provides the non-recourse loan and not having to pay back more than what the home is ever worth. Today, what that looks like is ongoing. It's 0.5% of the loan balance is assessed annually on the loan for that protection. And then in addition to that, you have the upfront. So at the time the loan closes, it's going to be 2% of the max claim amount. In our world, max claim amount is that $679 number or the appraised value of the home, whichever's less. That's where we come up with the upfront mortgage insurance. There's lots of myths that go on with this product. I don't want to really harp on a whole lot of these. The lender owns the home. No, that's just not true. But that is what a lot of people think, and that was a potential back before FHA got involved, right? Loan proceeds are taxed. No, they can use the money however they want. There are restrictions on how to use the proceeds. No, this is their money. This is their equity. They have spent years, time, sweat, effort to build up this equity. They can use this money however they want. Now, when we look at how much someone can get, what we have on the screen here is the example that I have is a $500,000 home, and here is the what we call the principal limit, the total amount that you can borrow on day one with a $500,000 home at age 62, at age 72, and at age 82. Now, you can see that obviously you get more as you get older. Right, that's how the program works. That is how it's expected to go. However, I want you to keep those numbers in mind because it's not always an advantage to wait to get the reverse mortgage. Right, and I'll show you that in just a slide or two. So when we talk about accessing funds, right? You have the fixed rate loan. So there's, with the reverse mortgage, there's a fixed rate and a variable rate option. The fixed rate loan is a closed-end loan. Whatever you're available to take out on day one is basically, that's the loan that you have. So whatever is needed to pay off pay off any existing mortgage and the loan fees associated with the loan, any amount that's available above that is distributed to the borrower at the time the loan funds, and then that's it. That's their reverse mortgage. They can't access any funds going forward from there. On the variable rate loan, we do have several options. They have the lump sum, just like the fixed rate, but along with that, they have a credit line, which they can access for whatever they need. And more importantly, from my perspective, and one of the unique advantages to the reverse mortgage is the available amount grows every single year. Right? If they're not touching it, they have more next year than they have this year. Right? In addition to that, we have the availability to do monthly disbursements. So the borrower can select, your client can select to have money deposited to their bank account every single month. You can set this up by term, which is a specific period of time, or by tenure, which means it will last as long as the loan stays valid. So if you have a client who's 62 years old and they select the 10-year payment, we're going to calculate how much that is. That dollar amount will be deposited in their account as long as the loan stays valid. If they live to be 112 years old and maintain the home the way they're supposed to, is pay their property taxes and homeowners insurance, they're going to get 50 years worth of payments, guaranteed, right? Part of the non-recourse feature. Now, one of the other nice features about the program, you can do a combination. So a borrower can do 1, 2, or all 3 of these options with a variable rate loan. They can also change their mind. They can they can have a line of credit for a period of time, and if they decide, well, you know what, I really would like the income just to come in each month, I want that guarantee, they can reach out to the servicer, change their option, and the servicer will then begin providing them their monthly payments. All right, so I am getting a little too quick with my mouse here. So we look at the line of credit. I mentioned that it grows. So here again, we've got a $500,000 home, 62-year-old borrower with owing no mortgage on the home. They would have approximately a line of credit of almost $190,000 on day one, right? And because of the growth feature, because of the way the program works, if they didn't touch it, 10 years later, they would have $318,000. So at age 72, they would have $318,000 in that account. After 20 years, $536,000 is what they would have access to. 30 years, over $900,000. So if you think back to the original slide where I showed what you get at 62, 72, and 82, right? The difference was $25,000, $30,000, right? This is significantly higher, right? This is why I say it's not always a benefit to wait for the reverse mortgage just to get more money on day one, because if you set it up early and are diligent about the way you access it, you can have more money at the end. Plus then you mitigate against the risk of rising interest rates and or program changes impacting it. If you went with a 10-year option, right, again, the $500,000 home, 62-year-old borrower, they could get approximately $965 deposited to their bank account every month as long as the loan stays valid. Right, after 10 years, they've had $115,800 worth of payments sent to them. 20 years, obviously twice that, $231,600. 30 years, almost $350,000 has been given to them, have been deposited to their bank account through the reverse mortgage program. All right, so that's kind of my overview of the product and some of the specific information that I wanted to go over before heading into our strategies. So the first strategy is to use this as a hedge against home decline. So here you have a home, we'll say, again, $500,000. Let's say it builds up at an average pace over the next 4 years, right? But then we have a situation like we had back in 2007 and 8, and you see the home decline drastically. If your strategy included a HELOC in this situation, right, there's a pretty good chance that that HELOC is either going to be modified or just removed altogether because the value of the home has changed. If you had the reverse mortgage in the line of credit, it would continue to grow even to the point where your line of credit could potentially be worth more than the value of the home, right? With the reverse mortgage program, that's just the way the program works. It is perfectly acceptable. Nothing is going to change the red line. As we look at a case of transitional income, right? So here we have a couple who they're 62 and they need to retire because of health issues, or maybe at least one of them needs to retire. Either way, their income is going to be impacted, but what they have saved up for retirement, in this situation, I'll say it's an annuity. What they have in their annuity now, if they annuitize it today, it's not going to be enough. Right, we look into their 70s and 80s, we're going to say they need $2,500 or so a month from this annuity, and they would have to wait till age 70 to claim that. But if they claimed it today, they would only be getting about $1,500. That might be enough to get them through the next several years, but eventually it's not going to be enough. So let's take a look and see how a reverse mortgage might be able to help out, extending that time where they don't have to annuitize today. So again, if they went with a 10-year payment, they could get $965 a month. So option one would be to go ahead and annuitize today and get the reverse mortgage with the 10-year payment at age 62, and that gets them close to the $2,500 that we talked about if they waited to annuitize at age 70. And while this works, it's not the option that I would actually suggest. There are some risks involved with that, specifically because that means the loan has to stay valid. If for some reason they have to move, then the $965 goes away, and now they're still left with just the annuity. However, if they hold off on annuitizing and they do an 8-year term payment, right, with $75,000 held over in a line of credit, they're going to get $1,415 a month. So that's almost what they would get if they annuitize today. But then in addition, they would have $75,000 in a line of credit. And then at age 70, these payments would stop, but they could annuitize back at the $2,500 that the growth would happen over the next 8 years. If we just went with the full line of credit, they could, or the full 8-year term without a line of credit, they could get over $2,400 a month. And then at the end of the 8 years, they would be able to annuitize and have the money left over. So if in the perfect situation for me, it would be this middle column would be the one I'd be looking at, trying to preserve as much equity of the home and give them that safety net of $75,000. But any of these three options are going to help get them to where they need to be long term. Our next case study involves stretching out the retirement account. So I've got a 62-year-old couple with $500,000 in a retirement account. Their home was worth $500,000. I'm going to say that what they need is $40,000 a year from that retirement account. So over and above what they get from Social Security, it's going to be $40,000 in the first year. We're going to go with a 3% annual cost of living inflation and a 15% tax bracket. Now for the retirement account, what I assumed was half of it was in bonds, half of it was invested in stocks and mutual funds, and I based the returns on the S&P 500 returns. I basically took the last 30 years, picked them up, moved them over, and dropped them in for the next 30 years. All right, so what we're going to try to do is use the HECM funds to offset the increased cost of living to extend the portfolio. So what you see on your screen now, the green bars are if there were no HECM at all. If they had the $500,000 and everything they needed to live was based off of the retirement account that they have with you. All right, so what we see here is around age 82 or 83, there's a significant concern of running out of money. Now the blue bars, what the blue bars are is that's using the reverse mortgage to take up the amount of increased cost of living. So basically the blue bars are a consistent $40,000 a year drawn out from the retirement account, and as the need grows higher than that, that's what you take from the reverse mortgage, from that line of credit. Right, so it's going to be pretty small in the first several years. As it grows and grows, that's fine because your line of credit is growing as well. As you can see, the blue bar also does not take into account the reverse mortgage line of credit. This is strictly the retirement account held with you. right? So you can see here that even after age 90, 91, there's still funds available for them to use for retirement when you're using your reverse mortgage this way. Our next case study, allowing the retirement account to rebound. The situation is exactly the same as the previous, so I'm not going to read that. The idea behind this one is, if it's bad enough when the markets are down, why exacerbate the problem by pulling out money on top of it? So the idea behind this case study was to use the retirement account to fund your living expenses when the markets are up, but when they're down, don't touch them. You take your living expenses out of the reverse mortgage line of credit. So when we do that, what we see is the blue bars here are the years where the S&P 500 was up. So you would take your living expenses from the retirement account. When they're down, the green bars, you would take all of your living expenses out of the reverse mortgage. Right, so you can see here over a 30-year period, there's really only 4 times that we'd be taking money out of the reverse mortgage, but at least it keeps us from having to take it out of the retirement account. And even at the end at age 91, there would still be $47,000 left in the HECM, in the reverse mortgage line of credit. Our last case study is deferring drawdown until the required minimum distribution age. So again, exact same situation. What I've done with this one is all living expenses at age 62, all retirement living expenses are taken out of the reverse mortgage line of credit as long as possible. My goal was to get them all the way to 70, right, 70 and a half before when they'd have to start taking money out, right? Unfortunately, not unfortunately, but just given the nature of the product, we weren't able to do the full 8 years. However, we were able to have the line of credit cover all expenses through age 66. So basically the first 5 years of retirement, they're not touching that retirement account. It's allowed to grow. You're allowed to continue managing it and grow before you even start taking any money from it. So the red bars are the same as the green bars from that first graph, right, showing that we're out of money age 82, 83. The blue bars are what happens if we don't touch it at all until age 67. And then at age 67, all money comes out from the retirement account. I did take into account the required minimum distribution, and there were actually a couple years, I think it was 85, 86, where the required minimum distribution exceeded the what was needed for living. So obviously in that situation, you can do whatever you want. However, there is an advantage to paying down the reverse mortgage. A, it reduces the liability. B, there's a potential tax consequences. And C, it gives them back a portion of their line of credit to be used later if necessary. The last thing we want to talk about, last part of my session, is the right sizing of the home. So here we have someone who wants to move, whether it's to be closer to their kids or maybe the house is just more than they need. Right, so they have a $500,000 home, and the home they're looking to buy is around $350,000. So I assumed an 8% cost of selling, right? Realtor fees, all the other fees associated with selling a home, which netted them $460,000. Their new home is $350,000. That left them with $110,000. Not bad, perfectly fine. Right? They get the house. They don't have to make a mortgage payment. They have $110,000 left over. However, if they were to use a reverse mortgage, what we call the HECM for purchase product, right? They'd have the same net proceeds from the sale of their house. House is still the same amount. The HECM for purchase would cover almost $160,000 of it. So rather than coming up with $350,000, they only have to come up with $190,000, leaving them, instead of $110,000 left over, leaving them over $250,000 of cash, right? Of cash that you could help them with to help them live out the rest of their retirement. So there are a lot of ways that the HECM for purchase can certainly be an advantage for borrowers. So thank you very much, everyone. That was the end of my section. We have our quick summary that goes over the product and how it's safer for borrowers today. But I want to try to leave as much time for Becky as possible.
Thank you. So the main focus of the comments that I had today is just kind of having sat on both sides of the fence. I wanted to share some things that I had observed over the years, and things that I'd heard others say, and things that I'd learned as I've been through the different chairs. The first one is, I think it's very common for advisors to think that they may not have many clients that this is appropriate for, and therefore they don't learn anything about it at all. And clearly you're here on the call, so that's not your situation. But I think people would be surprised once they start thinking about how the program works and what it can really do. It was never a shortage of people who continue to have more and more and more clients that this was applicable for. So I think, while even a high net worth practice, sometimes people would think that it really doesn't apply to their clients, but we've all got clients that we've had for a long time, and many of them have outlived what the plan was initially put together to be, or are getting close to that time point. So even for people who think my clients are all high net worth, this isn't something that's appropriate, I really challenge that. And I think it's all about, in many cases, what's the smartest use of leverage and what's the best place to draw down funds from, given the returns that you're going to give up if you step away from some of these investments. So while people may have plenty of assets that they could be drawing from, it may not be the smartest place to draw from when you look at what the interest rates and the costs are. So you just have to balance that out. The second thing that I wanted to mention is, I think you have to go into conversations with clients with the expectation that they're going to kind of wonder what the heck you're talking about when you bring up talking about reverse mortgages or home equity, because it's something that in many cases they've been taught not to use, but in most cases they just don't really understand how the program works, and what little they know, if anything, is based on old, outdated information. So it's really important to make sure that they understand it and that they're open to at least hearing more about it. And so I think it's important to expect that initial reaction, and the way that I've seen people successfully talk to their clients is to say something like, I know I have an idea for you, and I know initially you're going to look at me like I'm crazy, but I want you to hear me out because there are a lot of merits to it, and I think it could really be good for someone in your situation. And then just that kind of gives them the opening so that they're expecting to be surprised, which I think is where you want them to be. And then from there, I would ask them to set aside any preconceived notions that they may have, because if you just let the conversation stop when they put up that initial resistance, you're not doing them any service. It's your job to help make sure that they really have given some thought to the correct information and understand the program, because what I saw over the years is within about a 20-minute window, the body language goes from extremely skeptical to very, very interested almost 100% of the time. They just don't understand how they work. And so you got to get them to listen long enough to get through that initial explanation so that now they understand how it works. Now they understand the things that they may have been concerned about don't even exist or aren't what they thought they were. And then they're more open to listening to the conversation. The next thing is that because of the licensing, you have to work with somebody that's an expert in the field. Mortgages require licenses just like any other financial product. It's probably not worth the effort and the increased regulatory scrutiny to go out and get a mortgage license. It is a very worth your time endeavor, however, to pair up with somebody that does have that license that you feel comfortable with, that treats your clients with respect, that understands whatever boundaries you may have set up, that understands how involved you want to be in the process, and has really made an effort to learn about advisors and how you operate so that you can team well together and let them handle the clients. I think that's a real clean way to not only meet the licensing requirements, but also meet the requirements of whatever your firm is. I also think that we all have a responsibility to bring up the conversations within our firms, to talk to not only the people within our offices, but to talk to people in home offices and help them understand. Many of them don't know anything about the product either. And I've had some very high-level conversations with people over the years and I find out that they're just as surprised at how much more appealing this is than they expected as a client may be, or as you may have been when you first looked into it. So we have a responsibility to our clients to get this conversation on the table. As Jamie mentioned earlier, there's some responsibility here, and not having any information whatsoever, not being able to even discuss it with a client, is not a good solution. when we don't provide that information to our clients, they find it somewhere else, and the somewhere else may or may not be somebody that's got their best interest at heart. So I think it's really important that we become educated about these programs and how they work, and that we can help guide them in the context of how does this fit with their overall plan, because no one else is going to have that objective in mind. Nobody else is going to have all the details like you do. And so to be able to help them see how it all kind of fits together without being the person that's doing the loan for them, I think is a really important thing. And it lets you remain in the position of being their advocate. You don't care whether the loan goes ahead or not. You don't have any stake in the game. It's important, however, to be their advocate and help them be comfortable with whatever the decision is, and make sure that they've got good information so that they can make a decision. So I think there are a lot of things that are on us to really kind of help our clients through. And the only way to get through that is to get the information, get some scenarios so you can really see how the numbers work. Walking through the PowerPoint's a great first step, but I think until you actually put some numbers together and see how the program flows together, it's hard to really understand the full scope of what it can do for your clients. That's the end of what I had.
Becky, thank you so much for sharing your practitioner perspective on this. And thank you to Jud for presenting nuts and bolts and case studies and strategies. And of course to Jamie for giving us such a great overview of why housing wealth, why should we be thinking about this. So thank you guys so much for your presentations. Before we move to a couple of questions that were posed in our little chat box over here, I want to let everyone know that in the handout section, you will find two documents. One of them is a PDF of today's PowerPoint deck. So you can look this over, as Becky said, think about how these strategies could work for your clients. And then as you have more questions or you're thinking about being more specific and you'd like to try and find a lender near you, visit reversemortgage.org, where you can find members of NRMLA. All of our members follow a strict code of ethics and professional responsibility. So, and we will be posting a recording to our website later today. So you'll have that as well, and we'll be sending it to all of our registrants today. So you'll get a link in an email from us. So our first question I want to share with Jud, and it's what happens to the line of credit when the borrower dies without withdrawing all of it? So Jud, are you there? Can you handle that one?
Yes, I am, and yes, I can. So if a borrower passes away without accessing all of that line of credit, it simply basically it just goes right back into the home, right? It's just equity you didn't borrow. So when the home is sold, it'll just be more money available for either the client or their heirs should the borrower have passed away.
Great. Here's a question about the phasing out of LIBOR in 2021. So does that have an impact on how expected rates are determined, and what will be the replacement benchmark? Does anyone know the answer to that at this point?
Jenny, this is Jud. I unfortunately, I don't. I'm not as up to speed probably as I should be on that.
That's okay. I think that
the loan documents accommodate for a change in the index. In the case of the HECM reverse mortgage, it will be up to HUD and FHA to determine the new benchmark across all their portfolios, Jenny, and we just don't yet have a clear indication of what that will be, nor the timing of it.
Thanks so much. That was Steve Irwin, our Executive Vice President, so thanks for jumping in on that one. Here's a question that I think Becky or Jamie might be able to help weigh in on. It's what about financial advisors who are prohibited by their compliance department from discussing reverse mortgages? Is there a way to handle that?
I'll give you my opinion. I think you still have an obligation to your clients to give them a couple of resources that you think they may want to talk to, even if you can't talk to them about it. if they pick up the phone book, they may or may not land in a good place, and there's risk to that too. So even if you completely are not comfortable having any part of the conversation, I think you can learn enough about it so that you can help point them towards resources that are helpful, or point them towards NRMLA and see if NRMLA can help give them a couple of ideas of where they should be talking to.
Yeah, this is Jamie. I'll chime in kind of a couple thoughts on that one. Obviously, that's still a big issue, and as an advisor, certain of those things being prohibited from doing something based on your employer's rules. Unfortunately, for the most part, right, you still have to follow your employer rules, whether they're right or wrong. You are working for them, so you should follow them. That being said, that doesn't mean you can't discuss with compliance and actually push back. I think more advisors need to bring this up with compliance departments, and that can be done in a very respectful and helpful way, saying, have we reviewed our policy on this in a long time? And there are some companies right now that are making some good strides and making some changes there. But then most of the restrictions are typically on recommendations, and that's actually one of the things that I brought up, is you often can provide people the resources and information about something. That's almost never prohibited, but it's typically making a recommendation about a product that could be prohibited, but providing somebody links to resources, saying talk to an expert in that area, that typically is not prohibited.
Thank you, guys. Here's a question that I think Jud can handle. So it's regarding a variable rate HECM. Does the yearly factor of 0.5% increase on a yearly basis as the loan amount grows, or is it fixed with the original loan amount?
So I'm going to assume you're talking about the ongoing mortgage insurance premium, and if I'm right, then it will be based on whatever the loan balance is at the time it's assessed. So it's 0.5% per year, but it's actually assessed monthly. So each month a statement comes out, whatever the loan balance happens to be, it'll be 1/12 of 0.5%, and so it will go up as the loan balance increases.
Great. And a follow-up question on the credit line is, so if the borrower dies, leaving more credit line than the value of the house, how do the heirs get the money that is over the cost of the home?
Okay, so maybe let me clarify this. So the line of credit is technically it's just equity that they haven't borrowed yet. It's not taken out and put into a separate account or anything like that. So if a borrower passes away, and let's say they have $150,000 available in their line of credit, but their home happens to only be worth $100,000 because the home price dropped, they would only be responsible for paying back up to the $100,000 that the home was owed, but the $150,000 in the line of credit just isn't there anymore. Right, so that doesn't happen very often, but in situations where you have steep declines in the housing value, you could end up with more money in a line of credit than what the house is worth. But at the time the loan is due and payable, the line of credit it's basically not factored in, right? It's basically what the home is worth and what is owed on the loan.
Yeah, I think the simple answer for that one is that heirs cannot borrow money from the line of credit. So once the borrower has passed away, whether it's a non-borrowing spouse situation or heirs that then take over the home, they can no longer draw from the line of credit, period.
Thank you both for clarifying that. Here's a great question on HECM for purchase. And before I pose this to the group, I just want to point people to a nice article that Jamie just wrote for Forbes that explains HECM for purchase and points people to some really great resources on how HECM for purchase works. So the question is, if you have a client who wants to purchase a $1.2 million home, can they still use HECM for purchase? Jud, do you want to take that one?
Yeah, sure. Yeah, absolutely. They certainly could. However, we need to understand that the FHA's lending limit is still going to come into play at $679, and they're only going to get a portion of that. So let's say your client is 65 years old and they want to buy a $1.2 million home, they're going to probably have to come up with $900,000, and the reverse mortgage is going to come up with the other three. That's without running actual numbers, my estimate, that's how that would look.
Great. Well, thank you very much for that answer. That's taken us to the end of our webinar time today. I want to thank all of our participants, and I want to thank our speakers again. You guys were excellent today. Really appreciated all of your perspectives. We're getting some great comments on here. Thanking everyone for the information that you provided. Again, you can find slides as a PDF in the handouts. You can also find another resource from NRMLA, which is our self-evaluation. So questions to think about, topics to consider if you're thinking about a reverse mortgage or your clients are thinking about a reverse mortgage. And we'll be posting the recording to our website, and there will be a link to it in the email that you get from us after the conclusion of the webinar. So thank you all very much and have a wonderful afternoon.